Well, this week's economic calendar, jam-packed. Durable goods kicked things off this morning with a stronger than expected report. Tomorrow begins a two-day Fed meeting, and on Friday we're going to get the big January jobs report and the ISM index. So, should we expect the Fed heads to ever tap the brakes on QE or raise rates? Should we expect them to do it? The point is, the economy is stronger. Is the Fed going to move? Let's bring in two top CNBC contributors. Robert McTeer is former president of the Dallas Fed and a distinguished fellow at the National Center for Policy Analysis. Joseph Livornia, Deutsche Bank chief U.S. economist. You know him well. All right, Joe, very strong capital goods numbers today. Is the new year going to be stronger than people might have thought a month ago?
Oh, for sure, Larry. I mean, there's no question the corporate sector looks better. Housing looks better. Consumption looked healthy in December. Vehicle sales are probably okay. So, yes, I think relative to where expectations were, the economy is better. That changed the Fed's view, my friend, ex-Dallas Fed president?
The Fed will never change its view so dramatically from one meeting to the next. So nothing new will happen tomorrow, but it may affect what they do on down the road this year.
What if the jobs number comes out stronger on Friday? And that's a big number. They're targeting unemployment, right? Targeting 6.5% unemployment, whatever, 2.5% inflation, blah, 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 blah. What if you get a bigger than... I don't know this. I have no foresight. I'm no good at forecasting these monthly job numbers. I do know that jobless claims are falling a lot. So let's say you got 250,000. Let's say the unemployment starts dropping faster. Will that move the Fed?
Well, it'll move up the time in which they'll reach the 6.5%. It will encourage them, but it won't cause them to change policy right away.
In my lifetime.
Yeah, it'll be in your lifetime.
In my lifetime.
You take good care of yourself, Larry.
Joe Livornia, is an $85 billion across-the-board spending cut going to hurt the economy or not?
Spending cut, no. I don't think it'll help the economy, but I don't think it's going to hurt that much for a couple reasons, Larry. One, if the job market improves this year, as I think it will, there'll be a big income offset. The other factor is if we actually look at state and local job loss, it's very tiny now. Spending in the third quarter in the state and local sector went up. Federal spending is no longer shrinking. The $85 billion in the grand scheme of things isn't a whole lot. It'll hurt the economy.
16 trillion
16
GDP?
trillion in nominal terms. I mean, it'll hurt a little bit, Larry, in the short term, but if the private economy looks better, and Friday's data should show private domestic demand up about 3%, we could withstand that that spending cut.
3% economic growth?
No, the numbers will look weak, only 1.3, but if you take away if you look at core demand,
right,
GDP less inventories, trade, and government, we think will be over 3% in the fourth quarter, which is good, all things considered.
All right, so let me go to you on this. You're supposed to be a supply-side free market conservative. You're supposed to be. I want to test this brief test.
Okay.
$16 trillion GDP, of which we have federal spending close to $4 trillion. If we reduce the growth of that spending by $85 billion, it isn't really a cut in the level. It's just the growth. How can that hurt the economy? I think businessmen and women would like to see that. It would show we're not Greece. It would show that Congress is finally doing something. I think it would help.
If you go from here to there, it will help. There could be some problem in the transition. I tend to be a Keynesian during transitions, and a free market guy.
I'm sick. I'm getting a pit at the bottom of my stomach. You, Bob McTeer, free market guy, you should be saying how great these spending cuts look.
Oh, I agree. They're great. But I think if you start cutting spending and raising taxes all at once, there's going to be a transition period which it'll impart some weakness.
All right, there are some top tax rates coming, and that's not good. And there are some Obama tax rates coming, that's not good. But I just think the spending thing, that, Milton Friedman taught us that's a tax cut. Smaller government is effectively a tax cut.
You measure the burden of government by spending, not by taxing.
All right. Do you think the Fed, this is the big question, people are worried about bonds. 10-year Treasury bonds, right, have gone from about 140 last summer to just about 2% today, okay? Upward move. So the Fed's not really holding down bond prices, bond rates, even though they're buying so many. Let me ask you, is the bond play a sucker play right now? If you think there's stronger growth coming, and you see this stock market rally, which has great legs, corrections or not, great legs, is it time to get out of bonds?
Yes, some investors, Larry, have to be in bonds. They're benchmarked. They have certain liquidity and credit restraints, so they have to be in treasuries. But yes, as an individual investor, you'd want to stay away from bonds. And if you were a speculative investor, you would actually want to short bonds. There is absolutely no value in the treasury market. With nominal GDP even at 4%, let alone the possibility we could accelerate at some point to 5%. 10-year notes don't belong at 2%. They really belong somewhere over 4%. They won't get to 4% until the Fed actually starts.
They ought to be about where total economy is,
roughly speaking. There is a relationship between nominal growth and rates.
And I want to know if you agree with that. And I don't want to get too in the weeds, but the total economy, real growth plus inflation equals nominal GDP. Okay, we said that. This is CNBC.
2 plus 2 equals 4.
Thank you very much. Now, that's not a big number. In the inflationary days when I came into the business in the 1970s, we looked at nominal GDP of 8, 10, 12%, of which 6, 8, 10% was inflation. We're nowhere near that now. Here's my question. Is the Fed really as loose as people think they are? Maybe they're not.
They're not.
Right.
They really are not.
And maybe they should still do what they're doing.
You know, over the past 3 years, the money supply, M2, has only grown about 7.5 to 8%. Velocity has come down about half that.
The turnover
Turnover of money.
Yep.
And so you subtract the velocity from the money growth, and you get your 4% nominal GDP growth.
Which is not a big number. Which is not an inflationist number.
One could make the case that the Fed's been a little tight.
All right, I think you're right. Sell bonds. I think there'll be a little bit better growth. Not tons better. A little bit better.
Take what we can get.
Take what we can get. Thanks. Robert McTeer, Joe Livornia, thanks for the update.